All right, guys, welcome to webinar on opening a surf park, insurance lessons learned. Hopefully you guys can take some nuggets out of this presentation. Just an introduction and a couple of housekeeping things. My name's Cameron Annis. I'm our national practice leader for Granite Insurance's Adventure and Entertainment Division. And we'll go into in a minute just a little bit more about what that looks like. But today what we're here to talk about is we've fortunately been a part of several surf parks opening and growing their insurance programs with the opening of those surf parks from the ground up. And there's a lot of lessons that are learned in that, especially in such an emerging industry as surf parks, and one that comes with somewhat of inherent risk associated with that. And we'll talk about the opportunities, the lessons learned, and also the struggles that we've encountered as we've kind of went through this process with people. And hopefully it's lessons that everyone can take away from that so that you can benefit from it, but more so that the industry can benefit from it as well. The safer the industry is, the better off the industry is in general. You know, rising tide raises all ships whenever it comes to safety and risk management. Couple of housekeeping things. There should be a Q&A button somewhere on your screen. I'm not quite sure where it is on y'all's screen, but there should be a Q&A button there. Feel free to ask questions as they enter your mind. Don't wait till the end, but go ahead and ask questions. A interactive conversation is a lot better than me sitting here talking at you guys for 45 minutes or so and there not being any interaction. So the questions that you guys ask will sometimes be some of the greatest points. So please ask your questions. I believe everyone's cameras are off by default and mics are off by default as well, just to prevent background noise from people who may forget to mute their mics and things of that nature. With that, guys, we will go ahead and get started. Just a little bit of background about Granite Insurance. Granite Insurance, we're an independent insurance agency that serves a lot of the adventure and entertainment industry. We're a part of a larger group called Keystone. Think of it more as a country club. We own our own agency, but we belong to a larger bargaining power or buying power. And Keystone does roughly about $9 billion of premiums annually. So even though we're a small boutique organization, we still have the large scale and resources of a national organization and work with a little over 300 different carriers. Whenever people think of insurance, they think of a lot of times just, hey, get my insurance policy. But one thing that people should also be thinking of is what other resources come with an insurance partnership. And these are some things that partnership with Granite are different divisions that we have that work with people in the surf park industry and then also people in the adventure and recreation industry in general. The first one there is our risk management division. This is 80 safety and HR professionals who are there under the risk management division to serve and help you. Anything from risk management, HR resources, HR questions that you may have with an HR safety or an HR hotline and a safety hotline. Those are the things from Keystone Risk Management. Other things that I'll go through pretty quickly. Keystone Risk Partners is more of we call it our alternative funding from an insurance perspective. And this is whenever you get into spending really north of $2 million of insurance premiums. I'm not quite sure if you congratulate yourself whenever you get to that level. But you can think of things differently. You can think of how do we start self-funding? How do we start our own insurance company? This is our strategic unit that does more of those type of alternative insurance arrangements that you begin thinking about whenever you get into those larger premiums. We have our employee benefits team that helps clients out nationally whenever it comes to employee benefits coverage, especially whenever it comes to recreational operators and seasonal employees as well. And then we have our claims team who handles and administers kind of advising from your aspect. A lot of people, they just work with an insurance adjuster when a claim happens. We like to assign a different unit to that and kind of our own internal unit, which we call the claims team, which is kind of like your advocate. You don't always just want to be talking with the adjuster who's on the insurance carrier side. You want to have somebody that's your advocate there. And then Keystone Bonding. You guys probably in the construction phase, you may deal with some bonding. So that's probably the only phase where you guys will deal with a significant amount of bonding. That's more on the construction contractor side of things. So you guys may not deal with that too often. And the last thing I'll say, just kind of on an overview, of Granite Insurance. Before we get into what we've learned about the surf park world, this is just a little bit of background about who Granite is, where we came from. Granite was founded in 1936 as a local insurance agency. In 2014, we really stood up our adventure and entertainment industry, in which we expanded nationally throughout all 50 states. And over the last 12 years since that started in 2014, now we have over 500 clients, in addition to all of our other clients. But just in adventure and entertainment, we have a little over 500 clients, specifically in the adventure and entertainment world, whether that be ziplines, river outfitters, climbing gyms, water sports, hot springs, and now surf parks. So surf parks, guys, kind of morphed out of the water sports world. You got to think of the cable parks, things of that nature that were going on. A lot of those people kind of transitioned over to the surf park world and started that concept. And that's kind of how we got our introduction into the surf park world, probably 3 years ago or so. All right, enough about Granite, enough about who we are. Let's talk about the surf park world and the complications of insurance, especially for new operators, but really a new industry. There's not many, surf parks in the U.S. to draw from. And kind of the lessons that we've learned throughout this process is, number one, is some carriers consider this a water park. I'm sorry if you guys hear a helicopter. It seems like there's a helicopter going over my office right now. But some carriers consider this a water park. And you think about a surf park, and you're probably cringing right now when you hear that. Like, a surf park is not a water park. But to a lot of insurance carriers, that's the closest thing that they know to compare a surf park to, right? You've got this big body of water. You've got a wave generating technology. And whenever people put those two things together, they think, oh, it's like a wave pool at, a water park. When it's not in reality. So that's kind of a myth that we have to debunk whenever we're talking with insurance carriers about surf parks and what these surf parks actually look like. The next thing that we've really learned throughout this process is the lack of number of surf parks makes this a kind of a one-time bet for an insurance carrier rather than a series of bets. Think of the concept of insurance. The concept of insurance is a pooling of risk to kind of share amongst a group of people in the claims. So that whenever somebody has a massive, their building burns down and, their building is worth $10 million, that they don't have to come out of pocket $10 million to replace this. It's like, yes, this is the first fire claim that we've had in 25 years. We've paid premiums. But that is the concept of insurance, is, pooling this risk across the country. The unfortunate part whenever insurance carriers look at surf parks is that there's not a pooling. We don't have yet 50 or 100 surf parks in the United States where it's kind of a large, or, the rule of large numbers or law of large numbers where we can share those things. So when insurance carriers look at these risks, unfortunately, they have to price it based off of, all right, this is the only one or the only few that we write, and making sure that they're profitable within that single surf park operation that they insure. This is the staggering thing, and I'm going to go into a slide next that kind of shows the data behind this. And this is like, if you're a real estate developer, operator, whoever you are on this call, this is probably a very important point for you. Is what we've seen whenever we've analyzed a couple of different buckets. Number one, our clients that we have helped throughout this phase who have been new startups, or people's insurance programs prior to them coming to Granite Insurance, or just other people that have shared their information with us that are kind of that are not with Granite Insurance. There's a 254% cost variance whenever it comes to insurance, which is massive. You got to think if some operations are paying, and these aren't real numbers, but if some operation, that means if some operators are paying $100,000, then some surf parks are paying, $254,000. That's a massive variance and a massive swing, more than we see really in any other industry. And that's because of the the maturity of this industry is just not there. It's not had time to develop. It's not had time for insurance carriers to become comfortable with this industry. They've not had time to dissect data for 10 years to see actually the statistical data on how these industries are going to perform. And so that just leads to a big swing in the comfortability of each of these carriers that are operating in the surf park world. So whenever we look at the data in this, guys, this is kind of, and these are not actual operator one, operator two, operator three. This is just kind of a variance that we've taken from about 25 different statistical points and boiled them down and to show you like the variance in 5 different kind of options that we've seen from an insurance perspective among the common policies that you would see here on the left. And a couple of notes that I'll say here, and I know all of you guys, you're numbers people, so you're looking to the bottom here, and you always go to the total. And the first point is that is the variance of 6. The best kind of deal in the industry would be 6.56% of revenue. Okay, compared to the worst deal at 18.63%. I'll put an asterisk there and say, like, we have seen people in this industry paying north of 20% of their revenue in insurance. And what we're going to talk about on the back half of this is the why. Why are they paying that high cost? What controls these variables? And give you guys some really good takeaways of how you can make sure that you're on the left-hand side of the screen, down in the, mid single digits, the 6-7%, somewhere in that range, rather than the week before opening, you get this insurance program that says, man, we're going to spend 19% of our revenue in insurance. Like, you talk about something that upsets, the pro forma, that upsets investor expectations, that upsets sometimes even the feasibility of an operation. Like, this is what could upset the feasibility of a surf park happening. The reason we wanted to get into the surf park world was to ensure that that whole world could be successful. And the industry could be successful. We don't want insurance to be a barrier or something that's, kind of limiting the success of the surf park industry. If you look on the left-hand side of your screen and you look at these policies, I want to just run through a couple of these things. And I tied all of these percentages to revenue, just because that's easy. It's one metric that I can fit on one screen. When in reality, yes, liability premium is based off of revenue, but property insurance is not. Property insurance is based off of, the amount of values that you're insuring, essentially the replacement cost of these values or these structures and the lagoon itself. So, that's one thing that could swing here one way or the other is, the state location. For example, property insurance on the coast of Florida is going to be significantly higher than property insurance in, let's call it, Eastern Tennessee, right? Florida, you have hurricane risk, you have all those, wind risks, all of those things. In Eastern Tennessee, it's pretty safe from a property insurance perspective. But on the left-hand side, you can also see we designed in $6 million of total liability coverage. So another asterisk to this would be, what liability limits does your lender require? Does your landlord require? Or are you comfortable with? Some operations may say, no, we're not comfortable with anything less than $10 million. Some operations may come out of the woodwork and say, we're not comfortable with anything less than $50 million of liability coverage. Those are things that have cost impacts on this, but just for specking and doing an illustrative comparison, we used a $1 million liability policy and a $5 million excess policy. I'm going to take a pause there, guys. I'm going to flip over to the, so I see, so I see a statement there that says, no one is insuring at 5 million in today's world. Everyone requires 10 million these days. Can you speak to that? I can definitely speak to that. So the average cost of a fatality in the United States is $4.1 million. That is the average cost of a fatality. So a lot of people ask, how much liability limit should I have? Typically, whenever there's not any, it really, it's like, who's going to get injured? Is it going to be your average citizen that's injured, and it's hard to put a number on a life, but it's going to be the average citizen that is injured, or is it going to be a physician that had a spouse and 7 kids, and the physician was the only one working and supporting the family? And now you've got, you injure they either die or they injure their hand that they were, a surgeon on. Like those are the things that come into play whenever you're deciding the value. Glenwood, you guys may be familiar with the incident at Glenwood Caverns in Colorado that did go to trial. It was a death of a minor. I think the girl was 6 or 7 years old, and unfortunately she died at their facility. But I mean, Colorado, a jury decided that that was worth, I think, $211 million, $212 million for that. But to this person's point, like everyone requires 10 million these days. Honestly, it's dependent. We see some lenders require 5 million. We see some landlords and lenders require 10 million. We see some landlords and lenders require 20 million. A lot of that, in our opinion, depends on a lot of times the investors or the landlord's comfort level with this industry. For example, some lenders or landlords that are comfortable in the adventure and entertainment world, a lot of them are fine with, 5 million of coverage. It's typically whenever people are more unfamiliar with the industry that is the higher and the higher they go. If they're very unfamiliar with the industry, they may require 15 or $20 million of coverage. And that's a lot of times what we see. And also, it depends on the size of the investment they're making. If this is a $15 million project, it's a smaller scale project, maybe a standing wave versus a travel wave, lower cost, they're going to require a lot less than $10 million is what we've seen. Great point there in the Q&A. You guys keep those coming, and I'll keep those comments coming. Any questions or any thoughts that you guys want to throw in the Q&A, just on kind of the spread that you guys are seeing? And while you're thinking about those things, throw those in the Q&A, and I'll kind of go to the next slide, which really talks about how do you control this? Because I think that's the big question, is how do we not end up the week before opening in option 5, where we're upsetting the apple cart and upsetting our pro formas and upsetting our budgets and trying to focus on how the heck do we find, a 12% delta somewhere else to make up for this insurance cost? The first thing that I would say is, and this is 100%, and I am biased in this, is a bad jockey never wins the race. And what I mean by that is, we as your agent or broker, we see ourselves as a jockey in a horse race. We're the one guiding the horse, selecting which horse, being the carrier, which one's the best. And more importantly, like we're storytellers. Making sure that you have someone selected, whether it's us, whether it's somebody else, that has experience in the adventure and entertainment world is huge. Because if they don't know the right questions to ask you, they don't know how to pitch that story to the carrier. If they send the carrier just, some applications and they say, hey, here's a surf park that's opening in Colorado, please quote and let me know what you need. That's going to get an automatic declination from the carriers, and they're going to say, no, thank you, we're not interested. That doesn't tell the story, especially in a new industry. You got to tell the story. You got to make the underwriter interested. You got to make the underwriter feel like they're emotionally connected to this. You got to make them feel like this is a safe operation and they're not going to lose their job for placing $10 million of liability coverage on this one single risk, and essentially $10 million of their insurance company's balance sheet on this risk. So the thing that we recommend is, whenever you're working with, or even evaluating agents or brokers, is you've got to treat your insurance program almost like an investor pitch deck. You think of selling a surf park to investors, and you're pitching them to invest in the project. You've got to be able to do that from the insurance perspective as well. And we'll talk through some things about how you build that pitch deck here in just a little bit. But whenever you're talking with these agents or brokers, is the number one thing is you've got to know how you're being presented to the insurance carrier. You should ask those questions. What's your process like whenever you're talking to these carriers? How do you get them interested as us? What information do you need from us to be able to properly position us as, an elite surf park operator? They should eloquently be able to talk through those things and say, all right, in order to do that, these are the things that we're going to need, which sometimes is very difficult for a new operation. Think about, you're worried about getting revenue in the door, and whenever we're trying to stand up this insurance program, which may be 4 months prior to opening, you may not have those things developed out just yet. But we'll go over that is important to develop those things out early on in the process rather than waiting until the last minute to develop those things out. And kind of as I mentioned a minute ago um, is the agent or broker, are they just collecting applications, or are they building out a story? Are they asking about, hey, I need to see your lifeguard, training program. I need to see a diagram of the facility and where the lifeguards are sitting in comparison to the surfers. I need to see the route that the guest takes from entering the building to check in. How's access prevention controlled? What's alcohol consumption look like? Is there anything to control alcohol consumption? These are things that they should help you talk through prior to sending the submission to the insurance companies. Because if you're just sending those submissions to the insurance companies and allowing the underwriter to come back with a laundry list that long of questions, you're already acting from a reactive position rather than a proactive position. They shouldn't have to ask those questions. Your agent or broker should ask you those questions on the front end so that they can head off those and tell the underwriter those things before they have to ask them themselves. This is whenever you think about, all right, I'm opening a surf park. What do I need before going into the insurance marketplace? This is a checklist of everything you should need before going into the underwriting process. This is a document, and on the next screen, guys, you can take a picture of this, or on the next screen, I'm going to throw up a QR code that'll go to this on our website, and you can have that and download that on our website. But this is everything that you'll need from a documents perspective in order to be able to go into the insurance process, or before you send it to an underwriter or an insurance company. The last thing you want to do is go into the insurance marketplace before you have all these things, because you'll look very unprepared, unorganized, and it will create a lot of questions. And whenever those three things happen in conjunction with each other, what that really translates to is increased premium. That's how you get to the 18% cost as a percentage of revenue, is whenever you don't have these things panned out, and the insurance carrier really starts kind of getting squirmy whenever they're looking at these things. All right. I was looking at a couple more questions here, guys. Yeah, so somebody asked, what are a few risk management factors that you're seeing help drive down insurance costs? Great question, and I'm going to get to that in just a minute. So hold on to that question. Another question talks about can speak to business interruption today. And how the industry, unanticipated shutdowns can really take a hit on the viability of the business whenever there's unanticipated shutdowns. That's a great question, and I'm going to flip back a slide actually, couple slides here. So in this property insurance, within this property insurance line item, business interruption is typically included in this line item, or it should be at least. But what a lot of people fail, or a lot of agents that aren't familiar with this industry fail to tweak the policy to do, is include equipment breakdown in the business interruption. And the equipment breakdown specifically translating to the wave generation machine. If that machine is down for a 4-week period, because of an artificially generated electrical current that runs through it and fries up the electronics in the machine. Something of that nature. You need to make sure that that policy is triggering business interruption, so that it can provide coverage during that downtime, when you guys are down. So that's a great question and something that everybody should be thinking about. Think of, and all these things, you look at these and you see these coverages, and how I like to describe this as people is these are not off the shelf policies. The titles of them are, but the actual design of them are not. They have to be just like, a suit for a man or a wedding dress for a woman. Those are, you take them off the shelf and it kind of gets you 70% of the way there, but then you have to tailor these things specific to the operation. So each of these have to be tailored in that specific example, to the surf park world. A great example of that is the equipment breakdown coverage, making sure that it's in place specifically for the wave generation or wave generating machine and technology, and that also triggers business interruption if there's an equipment breakdown failure. Great questions, guys. Just gonna see a couple more that came in here. Mm. Do you see any benefits to insurance premiums going from one surf pool technology to another? Yes. And save that question as well. We'll get to that at the same time that we get to kind of what different risk management levers can you pull to control the insurance cost. So back to the operational documents, guys. I'm thinking of some of the most important things on here. All these things are very important, but if I were to point out like what is the most critical box here, is the safety, risk management, and training. This is the most critical box, and not a single one of these things do you want to skip. Not a single one. Like, could you get by with saying, yeah, we don't have our employee handbook developed yet, but we're working on it? Yes. Could you get by with saying, well, we don't have our vendor management summary kind of in place yet, but we'll get to it? Yes. But this box under safety, risk management, and training, guys, this is something that if you don't have one of these boxes, you're going to be significantly penalized in your insurance pricing. And probably even more importantly, you may get declined for insurance. And specifically declined is, there's a slew of carriers that will entertain surf parks. I would say right now there's probably 5 carriers that will entertain them. I didn't say they were all good carriers. There's probably 2 to 3 who can get aggressive on pricing, at least in a range that we would see as acceptable. If you get those top 2 or 3 that say, no, we're not going to look at this because we didn't provide a diagram of the facility. We can't get comfortable with it. They don't have their safety manual. They don't have training logs because maybe they're not documenting their training. They don't have any maintenance records, so they're not maintaining or documenting their maintenance of the facility and the wave generating technology or the machine. Those are things that are going to cause them to decline, the top, the best carriers to decline the account. And once they're declined, there's no coming back from it, right? There's no saying, wait, we can get those things. There's no coming. Once a decline is issued, like that stands for a year. And so make sure that this box here, like there's no cutting the corners, everything is done there. Even one thing that a lot of people don't think about is kind of these bottom 2, the lifeguard training process and procedures. That is so important. That is one of the most critical things that people are paying attention to when looking at your risks. And then also water quality management procedures. And frankly, the water quality management just stems because whenever you Google surf park incidents, that's one of the top things that come up. And that's what underwriters love to do, is Google when they get in a new industry that they're not familiar with, surf park incidents. And they watch YouTube and they look at articles. And whenever they see these things come up, the last thing we want to do is have to be, again, in a reactive position, addressing their questions about water quality management. We would much rather answer those questions on the front end and say, hey, this is what their water quality management procedures looks like. This is the testing that they're doing. These are the levels that they kind of go by. And then here's how they're documenting those things. All right. So that's operational resource document. Guys, you can scan this QR code here. This should take you directly to this checklist. I'm going to make sure it works on my end. Yes. So this is the kind of what we just looked at and a little bit more of a fancier 2-page PDF that you guys can save, print off, utilize, and check off as you guys are going and make notes and all of those good things. So I'll give you guys a couple seconds to scan that and download that if you choose to do so. All right. The next thing that we're going to go to, and this is something that's pretty cool. So again, as us as an agent or a broker, we represent over 300 different insurance carriers. And kind of what we said just a minute ago was there's probably 5 to 6 carriers that we work with, or that are even the U.S. We pretty much work with every insurance carrier in the U.S. There's about 5 to 6 who will entertain a surf park. But what we found out probably a year and a half to 2 years ago was most of them are also the people that play in the water park world. Not saying there's anything bad about that, but what we found out in the process as well is they look at these like a water park and they compare them like a water park and they rate them like a water park. And where we got frustrated with that is like this is not a water park industry. Like this is a surf park industry. It's, if you've got water parks that are here, in my opinion, surf parks are here. It is more boutique, it is more custom, it is more luxurious, it's more of a upper lifestyle activity. And so what we did was we created the world's first surf park insurance program. Essentially what we did was we got an insurance company to agree that, hey, you guys know the surf park space, design what the perfect surf park insurance program would look like, how you would measure the risk, how you would analyze all those things, present it to us, and we'll tell you whether we'll do it or not. And so we went through that process and we spent about a year, guys, investigating and talking to people. A lot of people probably that are on this call about how do we do this? What's important from a risk perspective? All of those types of things. And we designed that program. We are the only people in the world who has access to this program. No other agent, no other broker has access to it. This is our program. We developed it. And it's backed by AmTrust Insurance Company, multi-billion-dollar insurance company, and they're essentially the backers of this program. But you see this core visual here, and this addresses both questions on are there different technologies, wave technologies that carry different premiums? Yes. But not just by name, it's by functionality. That's the core reason of why it does. Number two is, what are a few risk management factors that are seeing help drive insurance costs down? Guys, and so this is a core visual. Let's count how many factors are here. And I'll kind of describe this. On the left is what we consider the risk factor. What's the thing that we're evaluating? And whether it says high, medium, or low, that's the impact that it has on the rating. That's kind of how influential we see this as, a risk determining score. And you'll see 1, 2, 3, 4, 5, 6, 8 things here. This is just a sample. So there's actually about 20 different risk items that we're evaluating. For example, one thing that you don't see here that is also included in a great risk management question, how do you lower cost, is how are you documenting your incidents, your maintenance, and your inspection logs? If they're by paper, they're in tier 2. If they're electronically done, then they're in tier 1, right? And so you could essentially go from tier 2 to tier 1 by just saying, you know what, let's get rid of paper and let's go to an electronic system and do it that way. We love electronic in the insurance world so much better than paper. Paper can be lost. Paper can be construed that it was just written the day before the deposition, those types of things. How this program works is, you see tier 1 here, you see tier 2, and you see tier 3. Each of these risk factors either gets a 1, 2, or 3, guys. So it's not like you're all tier one, you're all tier two, you're all tier three. You could be, a traveling wave, so you get 1 point there, with concrete surface bottom, so you get 3 points there. And then, you require helmets for beginners and barrel waves, and have a opt-out waiver if they don't want to wear helmets for everyone else. That would be tier one. So you add up those points, 1 plus 3 plus 1, and then you go through that whole matrix throughout the whole risk scoring, and then that literally translates to a rate, guys. And so the lowest, just like golf, the lowest score is the best, because you want to get tier one on all these things. How this is different than every other insurance company that, again, that we work with. We still work with all the other insurance companies that want to play in this space. They essentially look at your risk, they look at your operation, and there's nothing tangible like this. They look at it and they say, yeah, you're a surf park. I think you should be around 3% of revenues. And then you demonstrate, well, they're really good at this, this, and this. And they say, okay, maybe we'll come down to 2.7%. There's nothing like this that's tangible that says, all right, if you go from 1 to 25 lifeguard to in-water surfer ratios, if you go from 1 to 25 to 1 to 16, guys, moving 2 points here probably means the difference of $60,000 in premiums, right? $60,000 by just from going here to here. And then you can literally just take that and run it through your pro forma and see if the investment makes sense for your facility. Same thing from a safety audits perspective. Like if you're just doing internal safety audits specifically on like lifeguard safety and aquatics, you're here. But if you say, you know what, we'll do those monthly, and 2 times a year, we'll get an outside party to come in and do those things. Moving those 2 points, again, that's a high priority item there. That's probably $60-ish thousand of insurance premiums being moved. And so you can see how that just, tangibly works through that process there, and how that. And so to the question of the different technologies make up different premiums, 100%. I mean, I think the wave type, like it's just one of those things. And it's not like we like any wave type better than the other, or any wave technology better than the other. It's just simply the risk factor of those things and how we evaluate that. Any questions, guys, on how the rating structure works? Like what, why we set up this specific insurance program for the surf park world? Any questions or comments specifically on that? Feel free to throw those in the Q&A line item there. Awesome. To download a list for everything that you need to be, I'm gonna make sure this QR code works again also. Everything that you need to qualify for everything tier one. If you want to be a tier one operator just straight out of the gate, download this QR code. And this will talk you through the different categories and everything that you need to do to be tier one. And there's some things you're going to look at here, guys, and you're going to say, man, like there's no way I can be tier one because of the design of my facility. And that's okay. Like there's some things you just can't change, especially if the facility's already developed. But I will tell you the difference in if you were all tier one pricing versus all tier three pricing, just in the general liability policy. And let's say your operation did $10 million a year. And again, this is not talking about this is talking about for $1 million of liability coverage, just the general liability pricing. I mean, the pricing difference it's like $300,000. So I mean, we're talking about we're not talking $3,000 or $5,000. Like we're talking about a lot of money, over $250,000 by someone that would be all tier three versus someone that would be all tier one. I would encourage you to start looking at these things if you have not developed your facility yet, early in the development process. Just because if you think about that, $250,000 a year, and let's say you pan that out over 10 years, I mean, that's $2.5 million of extra profit or EBITDA that you could have in your operation just by designing the surf park intentionally around tier one practices. Scan that QR code and download that. All right, guys, this is kind of wrapping up on things. Anytime anyone ever wants to reach out for questions, to chat through these things, even to go through a mock rating on the tier system or to see more about the tier system, like we're happy to have those conversations in the development phase, or if your operation's up and running right now, happy to have those conversations. There's my contact information. What additional questions do you guys have? And again, nothing is out of bounds. Please ask any question you want to, even if I don't want to answer it. I'll see how I can answer it, and happy to follow up afterwards if I can't get an answer to you today on that. Yeah, that's a good one. Can you speak to timing of payments of insurance during startup? What's the typical first payment? Yeah, for cash flow. I think this is probably, I would say, if there's some operators on here that's probably saying, oh yeah, especially ones that have just started up, where cash flow in the insurance side, sometimes you think, oh, I've got a premium of $500,000. I'll just divide that by 12. And whenever I start opening, that's my fixed cost every month for the next full year. But in reality, that's not how that works. So I'll talk about this in two stages. Number one, pre-opening, you have insurance during the development process. So the two most notable things that you have during that construction phase or development phase is number one, builder's risk, which builder's risk is essentially property insurance for your facility during the course of construction. If you get 90% of the way through the project, big fire comes through, big hurricanes comes through, does a lot of damage. The builder's risk is what pays to replace back what was damaged. And then it can also be structured, again, to tailoring this thing for your operation. It can also be structured if there's a delay in opening to pick up business interruption from the delay of opening due to that fire or windstorm that happened during the course of construction. So that's the builder's risk. That can vary. Reach out to me if you want to talk about cost, similar to property insurance. Like, it just varies. Like, is it going to be in Florida, or is it going to be in Colorado, or is it going to be in California? It varies drastically by state, similar just like property insurance does. The second thing that you're going to want is a development liability policy in place. So even though the general contractor or the contractor is doing the work and you're like, yeah, but they have insurance. They do, which covers everything that they're responsible for. But there are things that you as the owner or that you or the developer are responsible for as well, or negligent for. You still want to have like a base liability policy in place. Think of if you've got the county commissioners or city council out there, or media, and you're doing a walkthrough of the construction facility and somebody gets injured while you're doing that. That's not the contractor's fault. You're the one guiding that. You're the one that invited them there. You're the negligent party. So you need to have a liability policy in place for that. All right, now let's flip to opening. The first policy in the opening that you're going to want to stand up is workers' compensation typically. And that's going to start whenever you hire your first employee. So when is that? You're going to hire the general manager the week before opening? I hope not, probably not. You're going to hire them a couple of months before opening. So, making sure you stand up the workers' compensation policy whenever you hire that first employee, which may be 3, 4, 5, 6 months before you open. What I would encourage you to do during that phase is make sure your workers' compensation policy is what we call in a monthly reporting form, and allows you to scale up that policy as your payroll scales up. So essentially what you do is you say, hey, we had this much payroll this month, which translates to this much premium being due, rather than paying premium for payroll dollars that would happen later in the year in month 1 or 2, which can be difficult from a cash flow perspective. The other thing is so that's the thing that starts first. The other thing is the rest of it's going to come pretty much right around opening time or the facility being turned over to you from the contractor, or the way the wave technology people essentially turning that over to you. And whenever that gets turned over to you, you can about bank on 25% of the premium being due up front, and then 10 payments after that for the remaining 75%. Sometimes there's a little wiggle room around that 25%, depending upon financials, what they look like. So that can be a little bit flexible, but that's kind of a baseline is 25% due up front. It's not just take the premium and split it by 12. Great question there. Trying to think of anything else around that. What other questions do you guys have? Any other questions kind of flow in? Awesome, guys. Well, number one, thanks for attending. Thanks for your interest in the surf park world. Thanks for us being able to be involved in that world. It's such an awesome world to be involved in. If there's anything I can help with, please reach out. A recording of this presentation will be sent to the email registered, so you'll have a recording of it if you want to share it with anybody or look back on it. If you want a copy of these slides, feel free to reach out as well. Happy to share any information that can help you. Hope you have a great rest of your Thursday, guys, and have a wonderful rest of your week. See ya. Bye.